But let's talk about the elephant in the room when we're talking about CEOs, right? Which is Elon. You can't help but think that wonder if Twitter is just a huge mistake.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. I created Wealthion to give you, the regular investor, access to what the experts in the investing world are thinking. And in our short lifespan, I think we've done a pretty good job so far in having an impressive number of revealing conversations with many of the best minds in money and the markets. But I'm extremely excited to talk with today's guest expert, Andy Serwer, who does what I do, but on an even grander scale. Andy's the editor-in-chief of Yahoo Finance, and he spends his days interviewing the giants of industry, Wall Street, and Capitol Hill. I'm really looking forward to this discussion. Andy, thanks so much for joining us today.
Nice to see you, Adam.
It's a total pleasure. Andy, you and I were talking a little bit before we turned the camera on here. You are the editor-in-chief of Yahoo Finance. That's actually where I started my Silicon Valley career. I've been on Wall Street for a little bit, went and got my MBA, and then the whole internet revolution happened. And then I found myself at Yahoo Finance as the head of marketing for it. So we've got a lot in common. I've got a lot of old, probably very boring stories that maybe I can tell you over a drink at some point if we meet up in person. But it's wonderful to see what you've been doing with that platform. And as I said, you are talking to the true apex players in terms of the folks actually driving the economy, the decision makers, the heads of the investing world. I'm really excited to pick your brain because you are an expert of experts is sort of the way that I look at you, Andy. I got a lot of questions here for you, but just as a jumping off point here, what's your current assessment of the global economy and financial markets, especially based on what you learned from all the folks that you talked to?
Yeah, big question, Adam. And first of all, thank you so much for having me on. It's a real pleasure to be talking to you. A lot of questions out there. It always seems like there are, even if you look back on a time period that's really quiescent or where the markets are performing so well for investors. Right now, it's really a tricky time. I mean, you look at what's going on, obviously, in Europe with Ukraine and how that's influencing the energy markets and the food markets. You look at what's going on in China and its problems of coming out of COVID and the exercise of free speech that we're seeing there right now and the implication on the US equity markets, stocks like Apple feeling those effects. But I think the biggest issue right now, of course, is rates and the rate cycle and the Federal Reserve and fighting inflation. And, the fight against inflation, we've been having this debate for months and years now about whether this blip up in inflation is temporal or not. We seem to have dissuaded ourselves of the notion that it was very temporary. Now, is it a bit temporary? And, the causes of inflation, we've hashed that out a lot, have to do with COVID and, of course, the war in Ukraine, as well as anti-globalism. So it's tricky stuff. The Fed is fighting it by raising rates. And, the last time we saw a big rate cycle up was in the 1970s, Adam. And most people don't remember what that was like, but I sure do. I was young and early in my career, but I remember the most exciting thing at the end of the rate cycle, people got so sick of equities. They didn't go up, stocks never went up anymore. People were just excited about CDs that were yielding 16%. And I tell young people about this, they have no idea what I'm talking about. Now, let's hope the Federal Reserve does a better job of fighting inflation today than they did back then so that this rate cycle is not protracted and we can get back to the races. But, we have this little move up in the markets right now over the past couple of weeks in September, and people say, okay, the all clear signal is out. I'm not sure if that's the case.
Okay, yeah. We've had some of our veteran guests here that have been investing for decades and remember what it was like back in the 70s, like you're saying there, Andy. And so they've lived through a couple of bad bear market cycles that today's younger investors haven't. And many of them said, the way to tell when a bear market is over is when nobody wants to touch stocks, right? You've had the capitulation. Everybody's so battered and bruised, they literally don't want to touch them with a 10-foot pole. And like you said, they just want safe, boring, anything that's just not losing money in a CD, great. That sounds awesome, right?
Yeah, and famously, you get magazine covers, right, which are
Yeah.
the signposts. And there was a very famous magazine cover in 1980 saying the death of equities, that stocks would never work again. And talk about like a raging buy signal. Of course, at that point, people didn't want to buy though because they were so burned. I mean, that was this basically a bear market that was 16 years. Going back to the late 1960s, the market went up, the market went down, point to point, it went absolutely nowhere. We definitely have not had the capitulation yet. Now, that doesn't mean that the market can't go up from here and that the inflation fight is over. I really don't know. No one does for sure. But we've been buying on the dips for a long time, and in a way that really includes 2008, 2009 as well. That was a pretty severe but very short, bear market, relatively speaking. Of course, 2020 was a very short bear market as well. The COVID bear market, the 1 month bear market.
Yeah, blink and you'll miss it bear market. Yeah,
exactly. Yeah. So we're used to these little snapbacks, and at some point there won't be a snapback kind of bear market.
Well, let me ask you about that. So, I think a lot of folks would argue that the reason why those bear markets were not super protracted was because we had unprecedented intervention by the central banks, right? And some might say, hey, that's what you got to do, right, in a crisis. I think a lot of folks would say, well, maybe, but certainly in the periods between those two crises, 08 and 2020, there was a lot of continued intervention in a way where people would say, look, that was unnecessary. And what it ended up doing was creating this massive asset bubble in everything, right? A lot of people call that the everything bubble. We had the housing bubble before that. We had the dot-com bubble before that, but 2009 to 2020 was sort of the everything bubble, or some might even say to 2022. And I'm just curious because you operate in the mainstream media, and I did not mention in the intro that before you became editor-in-chief of Yahoo Finance, you had a very long career at Fortune. So you have been in the financial media space since the mid 80s, I believe, so almost 40 years. And you tend to, well, let me put it this way. There is a criticism of the mainstream financial media that it has not been as critical of the Fed and the other central banks as maybe some people would like them to be. So I'm just curious, how much responsibility do you lay at the feet of central banks like the Fed for perhaps creating an environment that we are now sort of dealing with the reckoning of, that the intervention kept kicking the can down the road, and perhaps we're at a point where that can can't really be kicked any further?
Yeah, I mean, that's sort of two questions, Adam, which is one, what do I think about the Fed policy? And two, how do journalists cover it? And I'll answer both of those. Another side issue, of course, as well, particularly over the past couple of years, is not only monetary policy, but fiscal policy.
Yes.
I mean, so it's been both, of course, with a massive stimulus that we had in 2008, 2009, which was dwarfed by what we had during the COVID era. And I think everyone would acknowledge that put too much money in the hands of consumers, maybe, certainly a lot of money. The debate whether it was too much is the same debate as the stimulus debate that you asked me about when it comes to Fed policy. Yeah. I think you're right about that. It's funny because a lot of the criticism of the Federal Reserve, and this is kind of addressing both the Federal Reserve question and the media question, because a lot of times the criticism of the Federal Reserve comes from, let's face it, kind of like off the grid wacko people. Like, I'm against the Fed. Everything the Fed does is wrong. In fact, we should abolish the Fed. And so when journalists hear people criticizing the Fed, there's kind of an inclination, I think, and then people might not want to admit this, that those are the wackos, that the Fed are, these people are like super smart. They really care. They have all this data. They really know what they're doing. And I think that bias has not served journalists terribly well, because I mean, you look at Alan Greenspan, for a long time, he walked on water, a committee to save the world. But I think that it was kind of curious, and I think that some of us picked up on this, that gee, the training wheels are on for an awfully long time here.
Mhm.
Like, I bet you this kid, being the US economy, could really ride this bicycle without those low rates. And in fact, I mean, I asked, and a lot of people were asking, a lot of journalists were asking, like, what happens when they need to lower rates when rates are so low already? When there is a crisis. So, I think that in retrospect, and maybe even stronger at the time, I think calling those moves by the Fed, those moves being keeping rates too low too long, are valid. And I think that they suffered from not being considered mainstream, that they were like, oh, you're just kind of one of those wacky people on CNBC. They bring him on every call, but really, actually, this is very legitimate. And I think it got more credibility more recently. And I think it's unfortunate maybe the Federal Reserve wasn't listening a little bit better to that. Of course, easy for me to say. I'm not an economist. I'm not sitting there. I'm not smart, all these things. And I'm Monday morning quarterbacking. But I think it's a great question. And then as far as the journalists go, it's always the media's fault, Adam. I could find a million stories that were asking these questions and then calling them out, but maybe not quite enough, and maybe not quite loudly enough, and in the right places, which is the really prominent places, perhaps.
All right, great. Well, I appreciate you sharing that, and I'm not trying to push one agenda or not, but you just again sit at a rarefied altitude in that media space. So to hear even you say, yeah, you know what, the media probably could have done a better job of asking the tougher questions, really probing into this. All right, so back to the policy side of things for a moment. And I'm eventually going somewhere with all this, but you talked about monetary and then fiscal stimulus coming into the picture. The Fed is getting a lot of criticism, and I think in many ways rightly so, of the inflation that we're dealing with right now. And certainly in of course through the course of 2021, I think a lot of people are saying, look, the Fed should have started tightening a lot sooner, right? It kept adding, what is it, 120 billion of QE, every month pretty much through 2021. But I think the Fed, maybe one of the reasons why it felt confident that it could do that is it had done QE, like I said, pretty much for the decade between the Great Financial Crisis and 2020. And that money wasn't really making it out into the economy and pushing prices up the way that we've seen over the past year and a half. That said, it was finding its way into financialized assets, and that many have said really contributed to a fast-growing and deeply unfair, or at least substantially unfair wealth gap, where basically those who own financial assets were disproportionately they're already rich, basically were benefiting disproportionately from that, while everybody else was getting kind of left out. And then when we had the combined the other part of the other barrel of the shotgun with the fiscal stimulus along with the monetary stimulus post-COVID, that really sent, and the supply chain kinks that sent prices really jumping. Then the assets until recently went even higher for the rich people, but those people who weren't benefiting from that, the great masses, were then getting really whacked by the increase in cost of living. So people have said, look, we've kind of blown this asset bubble, and now we've created this high cost of living issue where we're creating really kind of a societal issue here, where it's getting harder and harder for the average American just to get by. I'm just curious, again, from your perch, do you have an opinion on that point of view?
Yeah, that's a fascinating topic, and it's something that is actually getting a lot more attention, which is to say, what tools, when the government does fiscal and monetary policy, does it lead to wealth and income disparities? And I think the Federal Reserve under Jay Powell, for the first time, is becoming aware of that, understanding that their tools, not only do they not address income and wealth inequality, to your point, Adam, it may exacerbate it, right? And it's kind of a little bit of a duh moment, but it's out there nonetheless. And if you look at the Federal Reserve's papers they're really studying it and they're really interested in trying to address that. It's unclear exactly how they're going to do that. There are people with ideas about how to do that. Earned income tax credits and things like that. And I think you could argue that fiscal policy, was a bit more democratic in that it did put money into the hands of consumers, small business owners, et cetera. It does look like, what do those people do with money? Well, there are real estate, meme stocks, sports betting. Look at some of those bubbles since March of 2020, those three sectors, for instance. That's what people, and then never mind like pools and boats and stuff like that. Like, right. It's sort of like, it's like this upper middle class, definitely, but even middle class and possibly even working class, booms and bubbles of little things like that. And much of it was, unhealthy, and leads to problems. Some of it, people really, people forget, like, that stimulus money really did help this guy, tied this guy who owns a pizzeria. It really did help tide him over, so he could keep his business running. People do forget that in the main, that's what was going on. On the other hand, like, sports betting went through the roof and all those companies like grew tremendously at that time. Connected? I think so, a little bit.
Yeah, and this is, and it's funny, I actually wasn't planning sort of to get into this territory, but it's very interesting, which is, when you intervene, and certainly when you make money cheap and plentiful, which the central banks really have been doing for a long time, right? But we sort of did in the extreme following COVID, right, with the trillions of both monetary and fiscal stimulus. When it becomes cheap and plentiful, you get malinvestment. That's just sort of what history has taught us, right? And we've certainly seen that, on the institutional side, but we've seen it on the retail side, like you're saying there too, right? No, so some people did pay down their debt. We did see debt balances, credit card debts and stuff go down, but we also saw a lot of, GameStop buying and boat buying and stuff like that, as you said. And so, obviously there are folks that would just argue, which is, hey, intervening just sort of always makes it worse, right? Why don't we just let the free market system just clear stuff out? And yes, that means there will be bust times that are hard, but then you get beyond them and you've set the foundation work for the next boom time and whatnot. So kind of where I was going with this line of questioning, and maybe I'll just fast forward to it, which is, again, you talk, every week with people who I think have sort of the clearest view as to where things are headed. Nobody has a crystal ball, but these guys have a lot of experience. And I'm wondering, are we potentially at a secular shift into a new era, or maybe even several new eras? And I'll give you three things to react to, and then you can answer any way you like. One, you sort of started this conversation about inflation and rates. For the past 40 years or so, really for almost all of your career in covering financial media, there has been a disinflationary tailwind in the markets, with rates just going lower and lower and then basically held at zero, for a number of years. Are we seeing a secular shift where, the cost of capital may be higher going forward? And maybe even, having higher inflation as a result. There's already whispers going on that the Fed may raise its inflation target from 2% to 3% from here. A few trial balloons have been sent out on that. Secondly, back to the point of intervention, there's been a lot of intervening by the world central banks. Are we potentially entering an era where they're saying, that maybe created more problems than we thought, and maybe the central banks need to take a lighter touch going forward once we're through this path? Curious on that. Yeah. And then the third part is back to the social, wealth inequality part. Maybe we be seeing a point where they've said, hey, we've really over rewarded part of society at the expense of the majority. Maybe we need to do something about that going forward. So I know I just hit you with three questions. Feel free to answer whichever ones interest you most.
Okay, I'll answer all of them. How about that? Because they're all interesting, all good questions. Just take the last one first. The over rewarding thing, I think that is something that they're studying and looking at. Just that maybe these tools that Washington has, both in the White House and the Federal Reserve, are too blunt. And, given all the data that we have now, before, think about it, Adam, like, 50 years ago, it's like cut rates. What happens? So you call the Kansas City head Fed chief up and said, how's activity? And he goes, real good. The loan book is up. I mean, that was the extent of data in the 1960s. Now they've got like just, how many people are doing exactly what with, Visa and MasterCard. I mean, there's just like, it's just amazing. I mean, that. So I think I would look for a lot more going on there. And I think that actually speaks to the second question, which is about intervention. And so just to address that a little bit more broadly, and I'll sort of loop back to this, specific targeting point. This idea that like the Fed did too much, well, okay, maybe. But there were two big lessons, right, of not doing enough or not doing anything. I mean, the not doing anything model was the 1930s. Like, oh, nope, because the free market's going to correct this sucker. And it sure did. Took 10 years, just like the cratering of the global economy. I mean, so much misery, suffering, death. Like, how many excess deaths were there in the 1930s because of that? Like, that's an unknown and probably ungettable number, but it's there. I mean, it was a miserable time. I mean, you've seen the movies, right?
Absolutely. And it's a politician's nightmare.
Right. So you got that. And then even in 2008, 2009, the argument after that was we didn't do enough. And so that's why the stimulus packages in 2020 were so robust, because look, we could have avoided that. If we had just done more, we wouldn't have had like, a year and a half of misery. We could have just prevented it. And, so flash forward to 2020, it's like, yeah, we had a 1 month bear market. Like, they prevented a bear market, and they really prevented, recession. It was a 1 month recession, I should say, and a little bit of a bear market. But on the main, they prevented most of economic havoc. But of course, then the Newtonian physics result was they created inflation.
That's a great way to put it.
Newtonian. Now, but because they created inflation by going too far, does that mean they should never do anything again? No, it just means they should recalibrate. And going back to this targeting thing, why not really try to target? In other words, if it was too broad brush, if you just poured too much gasoline, too much fuel in there, why not really try to study and really try to find the parts of the economy, the small business owners, okay, how can we do a better job there, right? Really making sure small business owners really get relief, because we don't really care. Procter and Gamble, you got like, I don't know, $20 billion in the bank. You guys are going to have a lousy quarter, maybe a lousy year, helping your employees. You should do that. But like the pizzeria guy, he needs help. Now, how do we make sure the guy really, helps his employees and doesn't buy 5 boats? If he buys 1 boat, we can't like govern that so much, but like, we want to stop abuses, and we want to make sure that his employees are taken care of. So there's a lot of work to be done. And these are the puzzles that the Fed and the White House, but in particular the Fed, need to really consider strongly going forward.
Yeah, and just on that point alone, there was a Bloomberg article that came out the other week about there was something like 37% of all small businesses could not pay their rent in full. I think this was in October, September. And, when you look at what's happened, over the past couple of years, but certainly since the pandemic, all the small businesses got destroyed by the lockdowns, right? Where the big mega corporations, most of them had distribution chains that could ship directly to home or whatnot. So they got to continue to operate. They oftentimes can borrow at much lower rates than the small business can, right? So there's just the playing field is sort of increasingly slanted away from these guys. Obviously, with the cost of hiring humans and whatnot, it's disproportionately more expensive for the small business to hire and maintain employees. They also can't afford to invest in robotics and AI and stuff like that, the way that the big companies can. So there's a real, I don't want to use the word existential, but like there's a real challenge here where it really is the small business that is the driver of jobs in America. And we are kind of hollowing out that part of the economy. And I think we, from a policy standpoint, need to ask ourselves, what serves us better? Kind of a robust and very diversified economy with lots of different players, or do we want a small group of just mega companies, the Amazons and Walmarts of the world, to kind of be the winners at the end of this game? This might be both above your and my pay grade, but I know you talk to people that think about this stuff.
Yeah, it's interesting because I was just thinking of what Gina Raimondo is doing at the Commerce Department, and one of her big endeavors is to, have companies manufacture here in the United States, in addressing those supply chain problems that we've had, which aren't going away because of, anti-globalism. I was just at a World Economic Forum lunch yesterday, Davos, and they're gearing up for that, which is a meeting of all the, global leaders. And Klaus Schwab, who's the head of it, was saying, hopefully reglobalization, we're going to enter an era of reglobalization. And I said, that's an excellent phrase. I said, I think you're too early. I don't think anti-globalism is over yet.
Yeah.
You look at, just look at Russia, China, and the United States. Like, even the United States is not, and Joe Biden is not whole hog globalist. Not at all. I think that of the three, he's the most global, and he's not against globalism, but it's not like he's not like he's Bill Clinton, who was probably the biggest globalist president we ever had, for better or for worse. So Gina Raimondo is trying to have, these factories here in the United States, so we don't have a China problem again, or a Russia problem, or an anything problem. She's been focusing on chip fabs, right? Which, when we were young, Adam, when I was young, you're way younger than I am, those were $1 billion. I think they're like 10 billion now, like a fab to build. But what about, like, to your point with these small businesses? And I look at there's a real technology gap. You mentioned this, that the small companies cannot afford it. Well, forget about it, robotics and AI. What about a server? What about like the guy running this feed lot? Like, he probably needs a lot more computing power. Does he have a lot of CapEx budget? He's like, what's that? I got a few laptops. What if there was a technology credit program at the Commerce Department for small businesses, right? A program, instead of, I'm all for building fabs in the Midwest. It's great. But what about in conjunction with that, or in addition to that, having a program where we have technology dollars earmarked for small companies to be able to compete not only globally, but also with big companies in the United States?
Yeah, I mean, I think a lot of people, especially a lot of people watching this channel, I think would be in big favor of that. I mean, to the extent that the government is going to, be putting capital investment back into the economy, seeing something like that, which sort of, much more democratic, raises all boats, creates lots of opportunity, versus the latest just massive big giveaway to, massive multinational X, right?
Mm-hmm.
To your, was that just an idea off the top of your head, or do you know?
Yes.
The idea is okay. So
yes, it was. But on the other hand, I'm sure my phone's blowing up right now. Gina Raimondo saying, we already have that program. Maybe, I don't know. Maybe she does. Maybe they do. Maybe someone else thought of it, but I invented it for myself right now. So, but it's probably out there already, of course.
All right. Well, look, you got my vote when you're running for office there, Andy. All right. Well, look, so, we've sort of cracked early into a couple of the bigger sort of issues that the economy is facing today. So again, you spend your time talking to a lot of the people that are, having to chart the economy into whatever future is coming, based upon the reality on the ground. And I'm just curious, first and foremost, like who are the voices that you think we should be listening to most closely right now? Are there folks that you interview where you just say, this guy's really got his finger on the pulse of key issue X, or has a great way of looking at the world? And just in the spirit of loading you with way too many questions, I'll tell you the next question I'm going to ask you after this one, which is, a lot of the people that you and I tend to talk to tend to be older, because they tend to be the people who have, risen to the top, and that takes time. They also tend to have the most built up institutional wisdom which makes them really interesting and valuable experts to talk to. But I'm also curious if there are any sort of newer, younger voices out there that you are particularly excited to see begin to take over the torch from the older guard. But first and foremost, who are some of the more, you think, meaningful voices to be listening to right now of any age, based upon their perspective on where things are headed?
Yeah, I'm glad you asked that second question, because a lot of times, you think about the older guys, and they're mostly guys, right? And I mean, there's a reason for that. It's like they have a lot of wisdom. They're also, they're in the vanguard, they're in the public eye because they've succeeded. In other words, they didn't flame out, right? And so, I've been very fortunate in my career to have had many conversations up to this day, this year, with Warren Buffett. And I mean, people always want to poke holes in him, and increasingly so, I must say, which is why he's taken a step back. He hasn't done as many interviews recently, not only because he's in his 90s, but also because of the political and social climate. He says, I can say that I'm for apple pie nowadays, and people are like, what? Oh, he's just like, he probably owns apples. Oh, what about cherry pie?
Right.
What about
Let's cancel him.
pie?
He's an Appleist. Let's cancel him.
Yeah, right. Let's cancel him. He's an Appleist. He just, and it's what Buffett calls tribalism. And he says, we're in a period that is just so incredibly tribal right now, that it is just, it's hard to say anything about anything without ticking someone off. So, I have my great business and my job, and so I'm doing it, and I'm not going to just put myself out there unnecessarily. So for all the people though that have been revisionists of Buffett, I would encourage them to take a step back and look at a lot of things he's done. Some people criticize him as though he's kind of a phony. He's just not really that avuncular, and but actually he really is. He is avuncular. He's just also brilliant, right? Mm-hmm. And that's not a contradiction. It's a paradox, right? Like, you're a brilliant kind of uncle guy, okay, old uncle. It just happens to be the case. He's gotten incredibly rich. He's built one of the biggest companies in the world. But if you believe in capitalism, that's good. So I still think it's incredibly valuable to talk to him, and also his even more senior partner, Charlie Munger, who's more opinionated and hilarious. And so that the Charlie and Warren show, continues at Berkshire Hathaway. So enjoy while you still can, folks, because it's not going to last forever.
All right. And before you go to the next guest, just on that, they're both in their 90s. I mean, Charlie's really getting up there.
Yeah.
You may or may not have insight into this, but once they retire, one way or another, do you have a sense for the new guard there? Or have they institutionalized their expertise and wisdom? Do you feel like the Buffett, not only the company, but just sort of the Buffett mindset, is in a good position to continue on after them?
I mean, we don't really know. I will tell you that place is like a cult in the best sense of the word, in terms of culture. It's pretty clear now that Greg Abel is going to be the next CEO, who, geez, I don't know how old he is. He's a younger guy, younger, probably 60s or something like that. I think he probably is, which is way younger than those guys. And there's a bunch of other very, very competent managers there as well. The investment managers, there's Ajit Jain in the insurance side, and there's the two money managers who are there. And I will tell you, one of the most brilliant things that Steve Jobs did was to pick Tim Cook, right? I mean, it may have been the single most brilliant decision or thing that Steve Jobs ever did. He picked an incredible successor. Now, switching over to Apple, I know a lot of people say, well, the Apple hasn't invented anything since he's been there. Like, well, that's true, but he's done an incredible job. I mean, the stock, if you had sold the stock the day that Steve Jobs died, you would have made a huge mistake, a huge mistake. And I know people who did that. They're like, oh, this is over. I would argue that the biggest job that a CEO has is to pick their successor. And the successor is a reflection of of their time and their tenure and their legacy. So, Buffett has just been, I mean, I went back, 25 or 30 years ago, and people were bugging Buffett about this, when he was in his 60s. Who's in it? So he's had a long time to think about it.
He has. I remember I actually met him briefly, probably 25 years ago, and this topic came up of succession planning, and he said, well, he spent a lot of time thinking about it, and he mentioned, he said, they find my cold body one day, the first line of my will says, well, check my pulse one more time before you read the rest of this.
Right.
So
right.
I guess it's been on his mind a long time that people really care what's going to happen after he goes. All right. So I interrupted you though. So you were talking about, obviously Warren and Charlie being really great voices to still listen to while they're still around.
Yeah. And I think that, just doing some other names. I mean, I think, Tim Cook has earned our respect, right? I mean, he has earned our respect. And Tim, weighs in on a lot of different subjects now, right? I mean, it's, I remember when I was interviewing the CEO of McDonald's years ago, and he pulled out the newspaper in Chicago and said, look, every single story on this front page pertains to McDonald's business. And it was like, war here, that affected their business, and the wheat futures there, and then the drought there. I mean, same thing with Tim Cook. I mean, every single thing on the planet impacts Apple, and Apple impacts everything on the planet. So, and he's a very, very thoughtful guy, and unlikely. I mean, think about where he came from and who he is and how he succeeded. So that is someone that I really listen to. I mean, the FANG CEOs, the bloom is off the rose. I mean, they could do no wrong, right? So we're talking about like Tim, and then also Jeff Bezos, and he's not the CEO of Amazon anymore, right? He kind of had a romantic thing, and Andy Jassy's the CEO of Amazon. He's kind of underknown, and but what Bezos did was incredible. And I don't think the era of Amazon and Apple are over. Google, same thing with Sundar Pichai. It's been a difficult time for him, but that company is going to be around for a long time and super strong. Some other Facebook. I think that there's just obviously a lot of questions about that company. But let's talk about the elephant in the room when we're talking about CEOs, right? Which is Elon. Elon. So Elon was supposed to be the American economy's next Steve Jobs, right? Maybe even better, because it wasn't just one company, it was like at least three. Right. With SpaceX and Tesla and, the Boring Company, and now it's Twitter. And, you can't help but wonder if Twitter is just a huge mistake. Just a huge mistake, and
just siphoning all his attention from all those other things. And
and like, oh, I get it's kind of important. It's the town square, but there are other town squares, and as a Tesla shareholder, I just can't imagine that you're happy about it. I mean, SpaceX is another incredible endeavor. What about SpaceX? And not only just diverting his attention, but also his behavior on Twitter, and just. Do you really want to be a troll? And like Steve Jobs could be like cantankerous, difficult, but he wasn't a troll. And you know why he wasn't a troll, Adam? Didn't have time.
Right. He was sort of maniacally focused on
the
project.
Care. I don't care. I don't care. Here's what I have to say about you. I don't care about you. Busy, right? He wouldn't like think of clever things to say and carry sinks around. Just no time for that, right? So I just sort of don't get Elon, and I feel badly because I do think, what he's done at Tesla has been incredible. He's revolutionized that industry. He's making the world go electric. He's sending us to space. It's all of a piece. It's amazing. And like, now you have to now he's in a Twitter fight with Tim Cook.
Right.
Well,
right. I mean, that Apple is now threatening to take Twitter app out of the App Store. Yeah, exactly.
Right. So all these people, and there's so many more people I could talk about, and we can see if you have time or want to go into more personalities, but these people drive our economy, our society, and the global economy and global society forward. And they're so fascinating, and they're not above feelings and foibles, right? And that's what makes it all so interesting, because I mean, we were just talking about this with Elon. Like, I don't know if, I mean, I think that he thinks that he's doing the right thing, but there's some ego involved in that as well.
Yeah, yeah. Well, I'm sure the ego is right on with that one. And it is a great point. You know, Twitter, just from a business standpoint, to your point, you know, he's involved in just massive disruptive companies. You named a few. There's still a few others too, like Neuralink and a few other ventures that he's in. It just boggles the mind, because any one of those would be a transformative company to build an entire career on, and he's just kind of creating them like barnacles at this point. But Twitter, you know, doesn't have a viable business model at this point in time. Like Twitter is not just trying to figure out how to keep the lights and servers running, which is what his time is really spent on right now, just because he's gotten rid of so many of the people out there. But you know, to your point, like it might not be a solvable problem, and it could be a huge distraction to the other stuff. So I do want to get to other people, because that's, you know, what makes you so unique, Andy, is you swim in the same ocean as all these people. I'm curious, have you ever had a chance to talk to Elon? Like, have you ever met the man?
I met him, but it was a pretty brief encounter. It was actually about a year ago, at the Time Magazine Person of the Year Awards. And he was given the award, and he presented to a small group, I'd say 100 people, and I was sitting there, Martha Stewart sitting there. Hey, Elon, when's the truck going to be ready? That was Martha Stewart's question, which I thought was pretty funny. But I bumped into him backstage and talked to him a little bit. He was with X holding his son, his 2-year-old, who he brought out on the stage. And it was so funny. He came out on the stage, and Ed Felsenthal, who was the editor of Time, said, "Oh, that's great. You're out here with X." And Ed was looking around for like someone to come take his son away so that Ed could do the interview. But no, it was just Elon and X were there. But I did talk to him a little bit. And I can tell you, and this is also, you know, just up close that evening, that, you know, he's just such a brilliant guy. But, you know, brilliance is not alone enough, right? There are a lot of, I mean, you know, like all these damn crooks. Was Bernie Madoff brilliant? I don't know. By some measure, I guess, brilliant enough to steal all those billions of dollars, but clearly had no moral compass. He was a criminal mastermind and a bad guy. Now, I'm not even beginning to suggest, you know, that, you know, these CEOs are that way. But in other words, like, you got to be brilliant and have great values and have great judgment. I mean, then let another person in the news right now, Sam Bankman-Fried,
right,
from FTX, you know, brilliant guy. I mean, you know, the son of 2 Stanford professors, right?
Well, not just professors, right, but lawyers, and I believe compliance lawyers, which is what makes the story so fascinating.
Yeah, I mean, you know, just incredible. And then his sometimes girlfriend, her parents are both professors at MIT. So we're talking like brain power coming up, boom. So you get a lot of brain power, but brain power ain't enough. You got to have a lot of other stuff up there as well, right?
Right. And of course, this is a lesson that's been learned many times. Older guards like us remember the failure of long-term capital management, right, which was supposed to be the smartest guys ever, right? And
Enron, the smartest guys in the room.
Enron, the smartest guys in the room, exactly. Yeah. So, you know, we've seen this happen a lot, right?
Oh yeah. I mean, and you know what's so interesting is that, you know, everything's different, right? Like, oh, you know, Tesla's different and Twitter's different and crypto's different, but really, like, all the lessons still apply, Adam. Like, you know, like a lot of the FTX problems with leverage, right?
Right.
And, you know, gee, that's timeless. And there's hubris is involved in a lot of this as well. And so, you know, sort of like the label and the form changes, but the questions of substance remain.
Right. All right, so I'm gonna go back to the original question because you're really wading into the exact territory I was hoping to get into with you, which is, so when you look at the panoply of folks that you have met and interacted with over the years, like you mentioned Warren and Charlie, you mentioned Tim Cook, like who are some of the guys that you just feel like this is the person who really has the right perspective or leadership qualities or whatever? Like this is a channel that gets watched by people, every day who are trying to leverage the insights of great thinkers, right? So
Yeah.
like, who are some of the people you're like, these are really good people to listen closely to when they speak? Because I think they really have it in terms of what we need.
Right. I mean, there's actually some good people on Wall Street. We haven't talked about them, and there's some familiar names, but I'm going to say them anyway, which are, Jamie Dimon, which are Brian Moynihan. And that's an interesting dynamic there. And I'll pause just get into that briefly. Like,
Sure.
Jamie Dimon, CEO, JP Morgan, has been there for a long time, done a great job. Had some dust ups there, of course. It's hard to run a bank for that many years without having any problems. He had the whale and other problems as well. But and Brian Moynihan has an equally great track record, really, at Bank of America. And Brian Moynihan just loves the fact that Jamie Dimon steals all the thunder. Now, you might think that's unusual, but basically, like, he runs cover for Brian. Like, Jamie's always out there. And I know Jamie's PR people, and they have an incredibly fascinating job because he shoots from the hip. And sometimes he just hits people's windows, cars, and all kinds of stuff. Boom, boom, boom. I mean, he just says stuff. And meanwhile, Brian Moynihan just goes about and does his job. There's Larry Fink, who's more controversial at BlackRock, but a very thoughtful guy, and he's gone full into this whole, stakeholder capitalism versus shareholder capitalism, going all the way back to Milton Friedman, right? And whether it's the primary responsibility of the CEO is to just maximize value for the shareholder, or does one consider the other constituencies? I read somewhere that one time, an incredibly well-run company, which is Costco, and Costco rated the highest if you looked at its ratings by its shareholders, employees, and customers. Okay. It was the company that scored the highest of the three amongst any American company. Think about that measure. That's an incredible measure, right?
Yep.
What other companies, when you think about the different constituencies? So I think that's super, super important. And you can read what these guys say. They put out shareholder letters, occasionally do interviews. So on Wall Street, those are some of the people. One other person, when it comes to economics, who can be a rub people the wrong way, is Larry Summers. And he's a really smart guy, and I love reading him. He's provocative, and he does not hold back either as well. So there's just so many interesting people. I mean, like Anthony Scaramucci, I get a kick out of listening to him. I don't agree with him with a lot of stuff, but I love people who have strong opinions and have fun ways of articulating things. It's kind of interesting.
Yeah. Okay. And he's a little bit, I mean, he's not a spring chicken, but he's a little bit on the younger side versus the Granthams, the Dalios, the Buffetts, et cetera.
Right.
So on that vein, are there folks whom the torch may be being passed to right now? I guess Musk would be one of them in terms of, kind of captain of industry.
Yeah.
He's 51 or 2 right now. But are there other sort of up and comers or younger voices that you are kind of looking at it with some excitement as, okay, I think this is going to be a good person to take the torch from these venerated older leaders?
Yeah, I mean, you look at some chip CEOs like Lisa Xu of AMD and Jensen Huang of NVIDIA. They're younger. They're tech names of increasingly big companies. I don't know, is Mary Barra that much younger? I mean, she's an interesting person. Satya Nadella, we didn't talk about him. I mean, there are people, they're not exactly in their 20s and 30s. Zuck is the youngest one, but I'm going to take a pass there.
Okay, sure, go ahead.
But these people in their 40s and 50s, I think maybe 60s in some of them. So there are always, new people coming up. And those are some names. I'm just trying to think of some other folks as well. Jane Fraser is a new, face on Wall Street running Citibank. I mean, she has a big job to do there. So it'll be interesting to see how she kind of, is able to execute, because, that company has not returned to its stature, from pre-2008.
Right. Yeah.
At all. So that's a real challenge that she has. So those are some names, I guess.
Okay, no, that's great. And look, like I said, this audience is one that loves to listen to the insights of people in those positions. So you've given them a couple of good names to go and research. All right, well, look, Andy. So again, you talk to these people all day long. I not so much, hey, Adam, you're filter of the consensus for what the experts think. And I believe that you probably have a lot of that same knowledge from your vantage point of just being able to synthesize a lot of what all these people have said. And then you come up with sort of your sense of like, okay, I think, from most people I talk to, they most of them seem to think X is going to happen. So I want to toss a couple of outlook questions your way, if that's all right. So we're talking here at the end of 2022. We're about to go into 2023. Economic growth has been challenging this year. First 2 quarters had negative GDP prints. We may be getting, much higher GDP prints at the end of the year. Though I think some of that is not necessarily driven by just organic growth. Some of that is with the way in which GDP is accounted for, that might make things look a little bit rosier than they are. Obviously, we still have inflation. While it's beginning to come down, CPI is beginning to come down, it's still quite elevated. That is compressing margins. We are seeing consumers weaken here. People are taking on more debt. The savings rate's going down. Real wages continue to drop month after month after month. So we're seeing sort of, the consumer spending outlook weaken here. And so anyways, there's a lot of people that are saying, okay, look, odds of a recession next year are looking pretty good. Let's start there. Do you agree with that outlook? Do you have a different take?
I don't necessarily, and I'll tell you why. We're in Fortress America, and things are not so bad right now. I mean, obviously the job market is weakening, but 3.7% unemployment. I mean, it's so it's not such a bad place. People are still getting jobs. People are losing jobs. I think about 100,000 people in the tech sector plus have lost jobs.
Yeah, like every couple of days, there's a 10,000 layoff.
Right, yeah. Exactly. The reason why I'm somewhat optimistic is because of the international arena, and that is, the world is being incredibly constrained right now by both Ukraine and China, and there's reason to believe that both of those problems can be resolved to a degree in the short to medium term. So Ukraine, like right now, Macron is kind of the president of France is trying to work on a solution right there. I mean, there's a Nobel Prize out there to be had for anybody who wants to solve that. Now, the whole trick is, withdraw with victory, or whatever we used to say in Vietnam, peace with victory or something. How do you make them? How do you create an exit? I mean, the Russians only control 17% of Ukraine now. I mean, it's like someone was saying a DMZ. That's not going to be popular either place. But at some point, that's going to get resolved, and I think sooner rather than later. And I think China is definitely going to get resolved. And the resolving I'm talking about is COVID and the lockdowns. And I think that, that Xi Jinping was looking to wind this up into the new year. But, there was that fire in Western China, which spurred these demonstrations now, which I think is going to encourage them to move maybe more quickly. Not that he's going to want to be seen as bowing to pressure. But in other words, if China really opens up, I mean, it's the last country with these restrictions. That's why the Chinese people are so unhappy. It used to be that China was more strict than the other countries. Now it's just a complete outlier.
Right.
No one does that stuff. I mean, I've been traveling all over Europe and the Middle East over the past couple of weeks. There's no masks, there's no testing, there's no quarantines, there's no nothing.
Right. And like
and I
in
think
China, they're still like locked in factories, like they can't even go home.
they just shut down Disney Shanghai. I mean, there's a 2-week quarantine to travel around to come if you're Chinese to get back to China now. I mean, there's the Chinese, officials can't. I mean, it's a mess. So when that opens back up, I'm not saying we're re-globalizing yet, but at least that's going to be just a huge, like releasing a spring into the global economy. And even if we get a kind of a stalemate in Ukraine, hugely positive for the global economy, and by extension, the U.S. economy. So, and the other, just one last quick thing about, I have never, ever in my entire life, 63 short years, remembered a time where everyone is so unanimously and unequivocally certain we're going to have a recession.
Yeah.
We are going to have a recession. I mean,
and so you're talking about the point of view that, look, if everybody expects it, then its likelihood of happening is actually probably.
Yeah. Now you could argue that two ways. I mean, and I think there has been a lot of like, we better cut back because there's a recession coming in, and that creates a recession.
Right.
That has been on the other hand, like there's just something cosmic about like, if everyone sees it, is it really going to happen? Like, right. Okay, and where, and that's like kind of a weird animal spirits thing. So please don't mortgage the farm on that, but it's just a weird thing I want to point out, right?
It's a good point. Hey, because you mentioned the word mortgage, what's your general sense of how the housing market's going to fare? Because we started this whole conversation on the topic of rates and what a game changer they've been. Mortgage rates have almost tripled since like 15 months ago or so. And housing had already gotten to a price where it had become extremely unaffordable for most new buyers. So do you think we have some sort of material correction due in that market?
Yeah, I mean, of course, real estate's all very regional. So, yep. I mean, rates are the thing that goes across all geographies. Right. But NoCal is different from New York City, although maybe not that much, those two geographies. But yeah. Iowa's different from both of us.
Yeah. Wichita, very different from where we
right, exactly. And of course, tripling, 1 to 3 is different from 5 to 15. Yeah. So to be fair there, no doubt, the real estate market has cooled. I mean, I know people who are real estate brokers and they're like, it's bad. Well, where this goes back to the early part of the conversation, Adam. It's like, this is a tool that is effective on that market, right?
Yeah.
I mean, raising rates does cool the housing market, and it does so across the country. I don't believe, we haven't really talked about this, but I don't really think, and this is a hugely controversial topic, and I love it, which is like, this whole thing getting back to another early part of the conversation, which is how temporal is inflation?
Yep.
I think it is somewhat. And there's, because, you got COVID, anti-globalism, Ukraine, at least two of those things at some point are going to go away. Anti-globalism, not so sure. But mitigating inflation are two very important things, which are slow and or low population growth, right? Number one, that's very anti-inflationary. And 2, technology, hugely anti-inflationary, driving down the cost of clothes, of oil and gas, of food, of manufacturing, of everything, all the time. Oh, those new fabs that Gina Raimondo is building, and they're going to be so much more expensive in the Midwest than in, but every day managers are going to be putting in new technology to make it cheaper and cheaper and cheaper and cheaper. Employment then becomes a problem, but, I mean, it's disinflationary, anti-inflationary. So, that's why I don't think inflation is going to be a huge raging problem going forward. And that's why I don't think mortgage rates are going to go to the moon. I don't think we're going to have a repeat in the 1970s here. I don't. Okay.
And obviously that point you just made is not just a point for 2023. You're looking out, decade
right
on that. Yeah. All right. And so I think I'm going to know your answer to this question, but it's a nice wrapper to the end of this conversation. By the way, Andy, thank you for giving us so much of your time. This has been a really fun conversation. So, general market outlook. So, the economy and the markets are not the same thing, but markets tend to try to anticipate where the economy is going. Sounds like you're saying economy might not be as bad as some of the bears are thinking it may be here. So my question to you is going to be: do you think the bear market of 2022 is largely over at this point, or do you think we'll slide into new lows next year? My guess from what you've said is you might be a little bit more sanguine on the situation, but don't let me put words in your mouth.
Yeah, I might be a bit more sanguine.
Okay.
So you're right, Adam. What is the? I'm just looking right now. The S&P is down 17% year to date, but only down 2% since September to here, right? So we bounced back from the September low, but we're still down 17% for the year. The question is, how many people agree with me about China and Ukraine, and is that baked in, right? And how many people agree with me about inflation, and is that baked in?
Right.
That's, that's what makes a market, right?
Right.
I'm a little nervous to say that, it's all upside from here simply because we haven't really felt that much pain. If you owned a big slug of FTX, you are devastated, but there's not that many people that really have that, or if they did, it was a little bit of Atlantic City money, as we used to say in northern North America. I'd be sort of more of a flattish, and then I think if one of these things gets resolved, I think that I don't think it is that baked in. This inflation, China, Ukraine. So one of those things, we get an all clear sign, a really definitive all clear sign. I think there'd be a lot of upside if we get a real hey, that thing's done.
Okay, great. So we've had a rough year, right?
Yeah.
When you combine stocks and bonds together, it's been one of the worst years in a long, some say centuries, in terms of the collective performance of both.
Yes.
So I don't want to use the word predicting, but you could see 2023 as being a bit of a snapback year, especially if we get some of these. I'm not going to call them black swans because we have a sense of what they could be, but some of these triggers that could be quite bullish to both economic growth and maybe just removing some of the anxiety that's in the markets, particularly around the war.
Right. Yeah. Of course. A little nuclear weapon by Putin, all bets are off.
Yeah. Let's hope that doesn't come into play at all. All right. Well, Andy, thank you. It's really been a total joy to finally meet you here, but also get to see the world through your eyes again, because you talk to so many people who are really, they've got their hands on the tiller in terms of where things are headed. So you have an access that very few people do, and so therefore your collective synthesis carries a lot of weight because of that. For folks that have really enjoyed getting to meet the man behind the interviews in this one, if they want to follow you and your work, where should they go?
Well, I'm still on Twitter at Serwer, and on Yahoo Finance. You can search for it, and but it's a whole team at Yahoo Finance does such tremendous work. So I'd encourage people to go there and look at all the great things that are going on there.
Great. And you have what is it, Influencers with Andy Serwer? Is that the name of your series there?
Yeah, exactly. Those are some long form interviews that I do of business leaders. Exactly.
Fantastic. Okay. Well, Andy, when we edit this, we'll put up the links there on the screen to your Twitter handle and your interview series and whatnot. But it's really just been a wonderful pleasure. Andy, thank you so much.
Thank you, Adam. Really enjoyed the conversation.
All right. Well, now's the time on Wealthion where we bring in the financial advisors officially endorsed by Wealthion. I'm joined as usual by the lead partners from New Harbor Financial, John Lodra and Mike Preston. We'll react quickly to what Andy said earlier in the interview here, and then we'll get into what the markets have done over the past week, because we've just in the past hour or two had Jerome Powell, head of the Federal Reserve, come out and deliver this month's key presser, and the markets have reacted to that. So let's see, guys. Mike, why don't we start with you? What's your reaction to Andy's our journey there with Andy?
It was good. It was a perspective. Andy's a journalist. He does a great job, I think, of covering the news and painting a picture of where we are, the risks that we face, and the path we've traveled. And really, there's a lot of talk about central banking and the Federal Reserve, because that really is all that the market has followed for so long. He says that when you asked him about the economy, he said these are tricky times, I think were his words. And they are tricky times because, frankly, just looking at the market today, the NASDAQ's up almost 5%. The S&P's up over 3%. And all of that happened in the second half of the day after Powell just said a few words, hinted at maybe slowing the pace of rate hikes. Tricky times when you can have a 5% move in a matter of an hour, and that's a good part of a whole year's gain, or in some years, so that's the kind of market we're dealing with that just really turns on a dime based on what the Fed says. And this is a market, as Andy said, it's been where people have been buying the dips for a long, long time. How long is that going to work? Well, it still seems to work, because here we are with the Dow down 6.4% off the all-time high. Looks like the S&P is down around 15.4% as we speak after today's big move. Those are pretty small numbers off the all-time high of what has been a really big blow off top, kind of parabolic move that came on the heels of $7 trillion in monetary and fiscal stimulus post-COVID time, post-March of 2020. And so we've been living through the largest bubble ever. We've seen everything go way up and some of those things go way down, everything being Bitcoin, meme stocks, art, houses, used cars, stock market, everything. And this market's been trying to top, in my view, for almost a full year, since December of last year. And Andy points out how every bear market's been really quick, and each one's been recovered quickly. And the 2008, 2009 bear market wasn't even a very long bear market, never reached undervaluation. That came right back. And then in 2020, we had a 1 month bear market and a 1 month recession. So now the belief is that the Fed will completely avoid all recessions and bear markets. And we think that's not the case. So there's so much more that he's talked about. I'll leave some content for John and for you to talk about. But he touched on a number of other things, including inflation outlook and so forth. We continue to think this market's very dangerous. It's frustrating for people like us that preach prudence and say the market's dangerous, because nothing seems to hurt the market. It seems to be relatively bulletproof and bounces very quickly. How long will it keep bouncing? How long will it be a dip buyer's market? Probably not for too much longer, but we can't tell the future. We know from data that valuations and market internals are bad if you care about returns in the future. So with risk-free rates above 4%, we'd strongly suggest that you keep a good slug of cash and treasury bills or things like that, waiting for better prices. So I guess I'll stop my sermon for now, but thanks for the opportunity.
All right. Well, John, we'll come to you here for your reaction to Andy. I do want to get into the day's massive jump that we saw. Of course, that was in response to Jerome Powell's press conference after his prepared remarks were released. Markets clearly heard something that they liked. But before we get there, getting back to Andy, people on the program ask me to bring in people who have differences of opinions. A lot of our recent experts, I don't select them for this, but people have interpreted them to be more on the bearish side. They've been wanting to hear some people who are more on the bullish side, just so we don't have an echo chamber here. Andy, by his own admission, is more sanguine than I think a lot of our recent guests on this program have been. Now, Andy is he's not a capital manager, right? He's not an analyst either, but he is a financial media expert, journalist who's been in the business for 40 years, as I said. So, he's been steeped in this industry for a long time, and he talks to the guys who are running the show. And as he said in the interview, he's not super worried about a further continuation of the bear market next year. He feels like it's either going to be, relatively modest year, or it's going to have potential for some of these big bullish upsides. A couple he mentioned, like peace with Russia, or maybe China reopening, stuff like that. So I'm just curious, A, what you took away from the conversation, and B, maybe you can react to Andy's sanguineness there.
Yeah, thank you, Adam. I too enjoyed Andy's perspectives as a journalist, and compliment to you in a fairly similar journalistic but much more educational role to be able to talk right toe to toe with someone of his tenure is a testament to what you built here at Wealthion. One of the things that I really appreciate about Andy reminding us and viewers is, most folks, even in our seats today, and most investors today, haven't really ever been through a true bear market, inflationary cycle market. The last real one of that sort was the 66 to 82 timeframe. There was almost 20 years there where the stock market went nowhere. Actually, it went a lot of places. It went really high, really low. There were several furious bounces followed by several furious declines, all to go nowhere over almost 20 years. And that was a similar period as today, in the sense that inflation was a problem, a bigger problem than policymakers understood it to be, and valuations were quite rich going into that period. So I'm glad he reminded us of that. Mike and I were kids back then. We weren't sitting in our seats, but we do have the ability and desire and thirst to go back and study market cycles many decades, and so we can take the learnings of those periods. But he likened, first of all, he talked about the sentiment of today not really being consistent with any sort of bear market bottom, and by contrast, he talked about in the early 80s how one of the main magazine covers, whether it was Newsweek or something like that, published a cover that basically said stocks are dead. Mm-hmm. And in fact, during that time, people didn't want to buy stocks. They had gotten so burned that a 16% CD, which, believe it or not, that's where they were, was all they wanted to think about. Yet we know with hindsight that back in 82 was one of the best generational buying times for stocks in all of history. So we look at those analogies and the differences of today versus then, but we also look at hard data. You can look at valuations. Today the non-adjusted, non-normalized Schiller PE is about 30, low 30s, somewhere in that ballpark. Back in 82, it was 6 and change. So we're 5 times more richly valued today than we were then, that true bear market bottom. And that's with earnings that haven't really, we think, digested the slowing of the economy that would be the necessary thing for a Fed to stop or pivot or moderate or whatever like that. And in fact, very few analysts have even priced in any kind of earnings degradation in the stock market. I think Morgan Stanley might have been the first Wall Street bank to kind of just this week come out with even a modest decline in their earnings projection. So we think there's a whole lot more beneath the surface of this market that is than just a headline Fed announcement that causes the market to flurry. I just want to remind folks, the Fed has presided over every bubble bust in the last, over time. I mean, the tech bubble of 2000, housing bubble, the Fed was right at the helm there, just like they are now. And in fact, they were easing interest rates pretty aggressively during both of those massive declines. So I know it's tempting to want to salivate at every Fed meeting or statement, but let's remember that they've presided over some pretty large bubbles that, in many people's estimation, were largely of their fueling, and lowering interest rates, if that's ultimately what they do, is oftentimes a sign of things really coming undone, rather than a sign of, hey, let's greet this with buying things to new and ever higher prices.
Yeah, and actually, let's take that last point there. So, I've been in recording interviews all day, so I really haven't had much of a chance to parse the specifics of the press conference there with Jerome Powell. But from the little I've been able to garner so far, a lot of what he said was actually relatively hawkish. He just had sort of one substantial dovish mention, which is really what the market glommed onto. And as you guys said, Mike, I think you were saying the S&P is up 3% today and the NASDAQ's up 5%, and that all happened pretty much in the last hour or two of the market action once Powell was giving his press conference.
Yeah, the
Right,
NASDAQ's up 4.5, and the S&P's up a little over 3. Yeah, quite a bit.
Yeah, just gargantuan moves in a very short period of time, right? So it looks like the quote that really got the market excited to make that big jump was the following. The time for moderating the pace of rate increases may come as soon as the December meeting, right? So you basically take that as the Fed saying, yeah, we might start slowing our roll in terms of how aggressively we hike going forward from here, and we could do it as soon as next month. So, you balance that with some of the other things that Powell said, like the Fed's going to need restricted to keep policy restrictive for some time. The rate peak is going to be likely somewhat higher than was forecast just back in September. So even though the pace of increases might not be as aggressive, he's saying we might still get to a higher rate than what we were thinking only relatively recently. And again, he seems to still be sticking to his, hey, look, folks, don't expect to pivot, right? We're going to get up there and then we're going to hang out there for a long time because we don't know exactly what's going to happen. So we're going to adopt a wait and see approach. And he in the short parts of the presser I was able to look at, he kept saying, history has shown us that if you reverse policy too quickly when you're trying to quell inflation, that tends to be a big error, because if inflation truly isn't tamped out, it just sparks right back up again. So he's actually still talking pretty tough, but the markets just said, hey, all we heard was, you're not going to hike as aggressively, at least as on a pace basis going forward. And we're interpreting that as we're sniffing out a pivot in that news somewhere. So Mike, what do you read here?
Yeah, I read just a market that is it's spoiled. It's and it constantly looks at the optimistic side here. There was a time a month or so ago where short-term pessimism was actually front and center. There was a lot of short-term, maybe it was 2 months ago now, September, when there was short-term pessimism and short-term oversold readings, and some of those were pretty extreme historically, but they have all reversed back and quickly and have gone completely in the other direction. We're back to optimism and maybe even a slight bit of euphoria here, because just look at the reaction. Like you very astutely sniffed out that the maybe the rates are actually going to be higher. Maybe Powell was trying to brace the market for higher rates than was otherwise anticipated, and yet saying, well, we might actually slow down the pace, but it may stay higher for longer. In other words, the ceiling will be higher. That should be negative, right? But all the market wants to see is the positive, and everything is so instantaneous.
It's sorry to interrupt you, but I believe this has happened several times already, where Powell has basically said, no, market, you're not getting it, right? Like, I don't think Powell wants the market to be jumping like this based on his comments. He's trying to tighten monetary conditions, and this is loosening them by having the markets rally by this much. So to a certain extent, the market, by jumping like this, may actually be increasing the odds that Powell is going to have to double down even further on his hardball tactics.
It might very well be a short-term, short squeeze here. There's a lot of option players in the market, a lot of short-term algorithmic trading, and short-term the market is only again sniffing out the positive. But that's the way I read it, and particularly after your comments sinking in, because this only happened in the last couple of hours. Powell is probably likely trying to manage psychology here. That's all the Fed has is their words, really. And that's their biggest tool anyway. And maybe they're trying to manage psychology. And I've got to think, if that's what Powell's trying to do, that he's disappointed with the market reaction here. And, ultimately that could result in a surprise to the downside. All we have to go on here is actual math evaluations, which remain insane. And so it's been a long road for anybody that's been talking about fundamentals and valuations and mathematics, but that's what we've got to go on here. And to me, it just shows a sick market that's just Pavlovian in response and wants its candy right now, so I don't think it's a
right.
good
Well, we really are setting up here a game of chicken where Powell is telling the markets, hey, look, I'm still going to do whatever it takes to kill inflation, and the markets are saying, no, we don't think so. We think you're going to change course sooner, right? And so it seems to me that of the likely things that could happen, when I look at the potential paths, it seems to me there's good potential here for the market really to be setting itself up for disappointment here. One is that Powell doesn't pivot, and Powell is true to his word, right? And at some point, the market has to realize, okay, we partied way too early, and we're going to have to bring prices back down to reflect that. Or it gets what it's looking for, which is a pivot from Powell. But what might cause that pivot is something truly bad breaking that forces Powell off of his, ironclad commitment to keep things going, to get inflation under control. And the conditions that would cause a pivot, conditions like that would cause that type of pivot, could be extremely non-bullish conditions, right? John, I see you nodding as I'm saying this.
Yeah, exactly. I think the kinds of things they've been looking for. Let's harken back to Powell's Jackson Hole speech this past summer. He was very adamant and purposefully using words like, we are going to feel some pain. We're going to need to feel some pain. There's definitely pain. There's cost of living has been very untenable for many folks. And there's been pain out there in that sense. But in terms of a broad economic recessionary type thing, big job losses, that really hasn't set in yet, and that's exactly what they've been trying to force on into the economy because they need to. So yeah, and even just 2 days ago, you had influential Fed speakers like James Bullard, the St. Louis Fed president, very hawkish. So there's almost a kind of a split personality going on here in the span of 2 days, which is just speaks to the psychological kind of torture chamber that oftentimes comes out, maybe intentionally, from the Fed and its pressers. I will note that everything rallied today. Gold rallied, bonds rallied, things were overweight,
and the dollar was down hard, which is
dollar was down.
So
some of the things, it's not just the U.S. stock market. Some of the things that have been very beaten up lately, and some of the things that we frankly have favored, rallied very strongly today as well. So everything got bought today except the dollar. I think oil was off, or at least some of the oil companies, but pretty much everything rose. Emerging markets, bonds of many stripes, precious metals, silver was up 4.5%, I think, today. Just one day. We Fed days are oftentimes head fakes. It's too early to say what happens from here. But yeah, the messaging all along has been, we don't want to stop accommodations too early. We want to get this job done, and it's only going to come by pain. And we just don't think the pain has been big enough to warrant a major policy shift.
Yeah, great point. And two things to add to it. One is on the pain side, as we've talked about a lot on this channel, we're sort of just beginning to see now the expression of a lot of the rate hikes that were made back in February and March, right? And there's been a whole bunch made since then that we still haven't really fully felt the full brunt of because of the delay in how policy is manifested. So a lot of that pain that you're talking about, John, that's all still ahead of us from here. So when we look out at the next couple of quarters, there's very little that I see that's going to counterbalance the very constrictive economically impact of these steps that have already been taken that have yet to fully be expressed here. So in terms of things like margin compression on companies, in terms of companies therefore having to lay off people, and we're continuing to see a steady drumbeat of layoffs happen here, in terms of seeing housing prices continue to roll over, so the negative wealth effect and impacts that's going to have, I just don't see a lot for the market to be front running here in terms of the removal of pain going forward. It seems like we're still going to have a lot to go through here, so we'll see. And then the other thing is, I launched an interview yesterday with Michael Green, and he said he's quite worried about 2023. He's much less sanguine than Andy is, and he said, I don't think we realize, we're lighting a match inside of a warehouse that we don't quite realize exactly how many explosives are packed in around us here. And he said, when you combine that with what he calls the obtuseness and maybe the deliberate obtuseness of the folks running the Federal Reserve, it makes him really nervous. And we spent a little bit of time as well regarding the Federal Reserve, talking about the political infighting that he believes is happening at the very top levels there, that you've got Lael Brainerd, who's gunning for, Powell's seat. So there are times where she is issuing dovish leaks. And then you've got Bullard, who's sort of trying to chart a middle course, both of them, hoping at some point in the future, maybe to sit in the Fed chair. It doesn't inspire confidence. I think the analogy I used, it's like being in a plane and hearing the pilot and co-pilot and navigator all arguing in the cockpit about how to fly the plane, and they all have a very different strategy of how they want to fly it. And you're like, that just doesn't make me feel good as a passenger in this plane here. So there just seems to be a lot there that just makes me kind of like you guys scratch my head and say, what is the market throwing a party for here? All right. Yeah. I see both of you guys nodding. Yeah.
I'm just wondering, am I the only one that thinks that these people have too much power? Maybe that's an extreme view, but they have so much power. And, it's very political, as you point out there, even though the Fed is not supposed to be a political organization. So that's the only comment that I have.
Yeah, on that point, Mike, one of the things that Andy shared as a journalist was that he was very kind in saying this, or maybe in towing the line a little bit, but that his peers maybe are a little too seduced or infatuated with the Fed, maybe don't ask the hard questions or challenge enough of the wisdom of the policies, and he'd be forgiven for, or the journalistic community might be forgiven somewhat for some of that, because there's been a few very poignant examples where journalists have asked the hard questions and put some tough questions in front of the Fed press people and Chairman Powell and his predecessors, and essentially have been shown the door, not given access. So there is a don't question the authority kind of persona around the Fed, and I think he nicely kind of, if not softly points that out in his peers.
Yeah, and guys, you remember we had Pedro da Costa on for an interview 2 or 3 months ago. I'll put up a link to that here for folks that want to watch it. But Pedro very famously was shown the door by asking us a tough question of Janet Yellen. And to your point, Mike, I mean, that's what he does for a living, is he covers central banks, most notably the Federal Reserve. And to get booted from, basically the press room is, it's almost an existential kill shot, in that industry. That being said, that's these guys' jobs, though. I mean, it is their job to get the right answers for the public. And I'll tell you, the little bits of the presser that I watched today, I didn't see anybody asking hard questions. Maybe they asked them in the parts I didn't get a chance to watch, but nobody there was taking Powell to task that I could see.
I just wanted to comment that I was talking to a new client yesterday that happens to be Chinese, grew up in China and then later in Taiwan, he said. And he said, did you see recently, and this happened in the last week or so, I think, and I didn't go and verify the video, but he said, did you see the video of the president of China sitting at the table, and on his side was Janet Yellen? I didn't see that. And he says, why is, the former head of the Federal Reserve sitting next to the president of China? And so I'm not sure exactly what that means, but it struck me as odd that they have a seat at the table with other heads of state, and that to me just seems very political and very just strange.
Yeah, well, and obviously she's the head of the Treasury nowadays, Janet Yellen. So maybe she can, treaded more political waters than before, but still, it's a great point, Mike. All right, guys. Well, look, as we wrap up here, John, I'll hand it back to you just to close any way you like, but I'll toss back out there again. It is now post-Thanksgiving. So we're heading into December. So we've got basically 31 days left in the year here. I know we've talked a little bit about in the past about end of year tactics like tax loss harvesting and stuff like that. But any reminder you want to give to people about things that they might want to consider doing here as the year is wrapping up?
Yeah, some really important things that folks should be making sure they do if they're of age or have of age that they have required distributions they need to take from their IRA accounts. Depending on when you were born, it's 70 and a half or 72. If you haven't already been taking them or been required to take them, it's age of 72. If you inherited an IRA, you're required to take distributions no matter your age. So that's all got to be done. There's some nuances there, whether you got to do it in the current year or you can defer to the following year. But the point being is you need to get those done before the deadline, which is typically the end of the year, or you face some pretty substantial tax penalties for not distributing at least the required amount. So our clients are well advised of that by us, and I can say we're largely done with those distributions for our clients well in advance of the deadlines. There's always thoughtful things to be thinking about in terms of tax loss harvesting, especially this year where folks might be down on some holdings that didn't do so well this year, whether stocks or bonds. Those are valuable losses to harvest to offset future gains or even a little bit of income, up to $3,000 of income on your tax return. And just be open-eyed here. We're in a really tricky part of the cycle, we think, and it doesn't mean markets can't go higher. We're actually every day, every week in our investment committee, we're keeping open minds to new positions we could leg into here, either because they're undervalued or showing relative strength, even though they may be overvalued. These are all things we consistently think about, but we do think that the environment still is very much one conducive to just being careful about downside. We're very richly priced in a economy that's probably going to start showing some more, painful evidence of recession. So,
all right, well said, John, and everybody watching. As we say every week, highly recommend that if you put into action even just that list that John just mentioned there, we recommend that unless you've got lots of experience doing it yourself, work under the guidance of a good financial professional who's got a lot of experience, who can, help you make the smartest decision given your personal situation there. If you've got a good one, great, stick with them. If you don't, though, or if you'd like a second opinion from one who does, and one that takes into account all of the macro trends and issues that Andy and I talked about, perhaps even John and Mike and their team at New Harbor themselves, just go to wealthion.com, fill out the short form there. You can have a free consultation with these guys. Doesn't cost you anything. No commitment to work with them. It's just a public service they offer. And as we begin to get into year end here, it's a really valuable time to do it, especially because you want to make sure that you're taking advantage of doing the right things, as John just mentioned, as the year wraps up. But you also want to make sure that you are positioning yourself as best as possible getting into the start of the new year. All right, guys. Well, look, thanks so much for joining me again here for yet another week. Everybody watching, if you enjoyed this conversation with Andy, would like to have us see more great guests like him on the program, please support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And whatever happens from here, guys, we will be deconstructing it for folks next week. Mike, next week, if we continue to see strong performance in the precious metals, maybe we can dive deeply into that with you next week. Gold's above 1780, getting in spitting distance of $1,800 an ounce. Silver's back over 22. This is momentum I think a lot of folks have been looking to see for a long time. Didn't have time to get into it deeply in this conversation, and also, don't want to put the cart before the horse. Let's see if these gains, persist for the next week. But if they do, we can dive deeply into that. Everybody else, see you next week. Thanks so much for watching.
Thank you, Adam. We'll see you soon.
Thanks a lot, Adam. We'll see you next week.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth. and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.